This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and co-host, Tyler Andrews.
Hello. Welcome to Clear Money Talk. I'm your host, CEO and founder of Clear Financial Partners, Tim Clairmont. And this is, as always, the illustrious, wondrous, amazing, phenomenal, and far better hair-styled Tyler Andrews.
Thank you, Tim. Yes, Tyler Andrews here in the podcast room with Tim. We are enthused, excited. We're recording this on a different day than normal. We typically do these on Mondays. It's Friday, so you got that Friday energy behind us today. So it's like you got the wind in your sails if you're sailing a boat, and that's going to carry us through another awesome episode of Clear Money Talk.
Oh, it's going to be awesome.
Excited to record it for you guys.
We're promising it's going to be awesome. We're going to make it great.
Yep, it's going to be a good
I have no
time.
idea what the topic is, but I'm sure it's going to be awesome.
It's gonna be a good one. Maybe a little controversial, but controversy can sometimes be good.
Interesting.
And depending on how you look at it, I think it's going to be an action-packed episode that many of you listeners have been asking questions about and wanting to learn more about. So buckle up, tune in, and hopefully we can bring a lot of good meat, clarity, education, and all that fun stuff to you guys on this episode. You ready, Tim?
Yeah, hit me. That's a lot of buildup, Tyler.
He's stressed. He's
I have no idea what I'm going to be talking about. Give it. You're
gonna love it.
Give
Okay.
it to me.
Topic of our day is how will the new tax bill impact your wallet?
Okay.
So
got
we've
it.
all been hearing on social media, news, newspaper, talking to your neighbors. If you got your head buried in a hole, you probably still heard about it. The big, beautiful tax bill.
Yes.
And it has finally been signed into effect, and we're going to slowly start to see those things rolling out as far as the new provisions of it and understanding the nuances of it, understanding how it might impact you and your wallet, if you will, I think is an important thing for us to talk about. Of course, I'll give the disclosure, Tim, we are not tax professionals. We're not giving you tax advice. We're not CPAs. We're not accountants. We don't replace your CPA or your accountant. However, this is just general information that we pulled from the internet and from our resources, and we want to share it with you guys and maybe talk about some practical applications of where some things might make sense to give consideration, and just to make sure that you don't step in a pothole if you can see that pothole coming.
There you go. Well said, Tyler. That's yeah. So I can nerd out on tax stuff all day long, every
you
day.
can.
That's a huge thing for me. For those of you that don't know, when I was 13 years old, I read The Firm by John Grisham and saw the movie around that time too with Tom Cruise. And that's what I wanted to be. I wanted to be a tax attorney. I'm a weird kid, so I've always wanted to try to keep taxes at their legal minimum for people wherever possible. And that's something that we do kind of on the side here as we work with our retirement income planning strategies for a lot of our clients. And we want to make sure we minimize not just your taxes each year, but your lifetime taxation over the course of your lifetime on the income streams that come out to you in your retirement. So when there are changes to tax law, the whole board gets reshuffled, and we have to make adjustments in our strategies and our plans, or at least consider adjustments. And that's what we'll be getting to talk about today. So I'm excited because I know that the bill just recently passed, and there are a lot of things about it that just codified the continuation of previous tax breaks, which is a big deal. There was a significant tax reduction that occurred with the Tax Cuts and Jobs Act that was set to expire at the end of this year. And if those tax rules did not get made permanent or extended, they were going to expire. And if they expired at the end of this year, pretty much everyone in the United States would have paid more taxes. Whether you like the administration or don't like the administration that has done the big, beautiful tax bill, or the Tax Cuts and Jobs Act for that matter, is immaterial in this. I would strongly discourage you from attaching your emotions to where these things came from. Instead, focus on the fact that they are what they are. These are the rules that they are. And let's try to figure out how we can use those rules effectively in your plan, because it is the tax law that we have now. And generally speaking, across the board, it's less expensive tax-wise for just about everybody. I don't think I've ever met anybody that would have had more money in the previous tax code before the Tax Cuts and Jobs Act. The standard deduction went up. That's now there in place, so everybody gets a automatic bottom line write-off. The tax brackets went down as far as the tax brackets went up, so you had more room at the lower brackets So you paid less taxes overall, and the tax rates in those brackets went down. So we ended up with lower tax rates in those brackets, fundamentally reducing taxes across the board. It was one of the lowest tax rates we've seen in the United States history in a very, very long period of time for this last decade. And I was expecting the groundhog to see his shadow last year, and ultimately we were gonna have an extension of winter or whatever. It was not going to be spring anymore. We're not going to be happy. We're going to have all these tax cuts go away. A lot of people were preparing for that, and now I think we're fortunate. We have this windfall of a lot of these tax cuts staying here, and there's even more tax cuts that have come into play now with this bill that weren't in place before. So let's talk about those, and let's see what you got lined up for us as far as the bullets.
I like it. I got 8 bullets for us, Tim. So I think we just hit them one at a time.
Done.
It's more or less. We can have a little bit of conversation, I guess, surrounding them, but it's more about here's what they are. Here's what how they're built into the bill, if you will.
Okay.
And
these are, of course, not the only 8 bullets that exist in the bill.
I think the bill is
giant,
very comprehensive. So
but these are 8 bullets we're going to pull out and share with you. So
these are some probably the most applicable to most people, if you will. Standard deduction, Tim, you already mentioned it. Yep. So it's here to stay. Plan accordingly, if you will.
There you go.
So individuals, $15,750. Jointly, married couples filing jointly, $31,500. So great. Just like we've been experiencing since the original tax cut back in 2018 or 2017.
Yeah, I guess that would be 10 years ago, wouldn't it? But
About
yeah, I thought it
10
was the
years,
2017 tax. Anyway, you can Google that, or ChatGPT that, or Perplexity that. But whatever you want to do in order to figure out the answer to that, you can find that somewhere else. Fundamentally, the standard deduction, just to explain it to you if you're wondering, what is this standard deduction thing? $15,750. If you're a married couple, $31,500. What that means is if you made as a married couple, for example, $100,000, the first $31,500 of your earnings, you don't have to pay taxes on. It's a standard deduction. Everybody gets it just for being alive in the United States, and that's the nature of how that works. And then they start taxing you on the money above that $31,500 number. If you're single, it's $15,750. So if you made as a married couple less than $31,500, or as a single individual less than $15,750, you would owe no taxes because your standard deduction would cover all of the earnings you made, and you would owe nothing at a federal level on your income taxes. And that's so it's kind of like the first freebie money that you can make without having to pay taxes on it.
That's exactly correct. And we've seen since the original tax cut, fewer people itemizing on their taxes. Most people were electing the standard deduction because it was such a larger amount than what many were used to for so long. And it was a layup, if you will, if we're talking about basketball terms. And we may see that change, and we may start to see more people itemizing as we start to go into some of these other provisions that are built into this tax bill, and
particularly in the state of Oregon and the state of California, which I'm sure we'll get to that in a second. If you're an Oregonian or a Californian, you're listening to this, there's a good chance you might bring itemization back into your taxes, and previously you might not have been itemizing. And the difference between itemizing, it's when you fill out that old form, Schedule A as an apple, and that itemized deductions was just a way of saying, hey, thank you for the standard deduction, Mr. Uncle Sam. You get this $31,500 standard deduction, but if you qualify with a larger itemized deduction, if it's bigger than the standard deduction, you can get that instead. So you don't get both. You don't get to stack your standard deduction and the itemized deduction on top of each other and not pay taxes, but they'll give you the bigger of the two. And for many people, because the standard deduction went up so much with the Tax Cuts and Jobs Act, the itemized deductions, the way that they were calculated, were not greater than the new high standard deduction. Consequently, people stopped itemizing in a big way. However, now that we're dealing with some of these other adjustments, which I'm sure we'll touch on shortly, might as well hit on it because we're alluding to it way too much. Fundamentally, the SALT, state and local tax limit, which was previously restricted to $10,000 per household, that meant that the interest deduction on your home would get factored in to calculate your standard deduction, and then you would also get charitable contributions, and then you would get primarily the total of all of your other local taxes, which would include property taxes on your primary residence, property taxes on a secondary residence, and your income taxes, if you have income taxes at a state level or as in Multnomah County, at a county level, all of those taxes get added together, and if it's over $10,000, you didn't get to count anything over the $10,000 limit. That was referred to as your SALT limit, because SALT, SALT, stands for state and local tax. That SALT limit has now increased with the big, beautiful tax bill coming to, I believe it's $40,000 now. Is that correct?
$40,000.
That's a much bigger number. So if you've got a nice income stream coming in the state of Oregon or California, as an example, Oregon's income tax rate's 9%, California's 10%. If you made $100,000 just $100,000 this year in Oregon, and you owe $9,000 in taxes on that at 9% as an example, or in California $10,000 in taxes on that, you wouldn't have been able to write off your property taxes on your primary residence because you would have hit the SALT limitation at $10,000. So if you owned a house, you had property taxes plus your income taxes exceeded that $10,000 limit. Maybe that was $15,000. That extra $5,000 over the $10,000 limit, you didn't get any benefit for that. It wasn't deductible. Not to mention the interest on your house. You got to get that factored in as well. That you might have still itemized if the numbers were high enough, but you're still only getting to count 10,000 of your state and local taxes. Now you can count 40,000 of your state and local taxes, which means if you make a few $100,000 a year and you're paying 9 or 10% on that. That could be $27,000 to $40,000 easy in income taxes that you're paying locally, and then you're going to get a much bigger tax deduction. Effectively, that's an extra $30,000 tax write-off if you're now itemizing and getting to claim all of that, and you were previously itemizing, which in a 31 plus 9 or 31 plus 10% bracket, or 33 plus 10, depending on where your bracket's at, could translate directly to an extra $12,000, $13,000 in your pocket this year, thanks to the tax bill. So,
yeah.
Sorry, that was a lot of numbers and nerding out, but you guys talked to me about taxes, and this is what's going to happen.
No, that was exactly what I wanted to happen. Thank you, and that was literally the next bullet point. The SALT deduction cap increased to $40,000. So
nice, excellent.
Hit the nail on the head. Thank you for that.
2 down. 2 down. Happy to hit the nail on the head. What's number 3?
Next one, we'll see how much we go into this one. Expanded QBI deduction for small businesses. So qualified business income deduction. It's 20% pass-through deduction now for certain business entities. Mm-hmm. So
do we know what it was before?
I don't know what it was before. No.
So QBI was really cool. I remember nerding out on this one. I read the actual Tax Cuts and Jobs Act bill, literally the whole bill. This was pre-ChatGPT, like 8 years ago. I couldn't just upload it and get some summaries and ask it questions and stuff. So it was long, and but I went through it all, and QBI was a very interesting deduction. I remember calling my accountant, and it was so brand new that he was trying to figure out, even what was going on with QBI at the time because it was so new. But qualified business income, it was an extra tax deduction for business owners. If you run a business, if you're self-employed, it gave you the opportunity to get just an extra tax write-off, so you wouldn't have to pay so much in income taxes. But there were phase-outs. There were certain industries that you got to count, and if your income was too high, you didn't get the deduction, and so on. So if they're expanding it, making it bigger, that's encouraging small business owners, your mom and pop shops, not your big businesses, those small businesses, your neighbors that are running a local fish market or a retail shop, or your realtors and mortgage brokers that are friends of yours, or your loan officers that are anybody that owns a small business could potentially benefit from this QBI deduction and make it a little bit easier for them to run their business, which it's hard to run a business. It's not an easy thing to keep your doors open, and that's it's nice to have that benefit.
Absolutely. Yeah. Thank you, Tim.
Yep.
Next is enhanced child tax credit. So per child under 17 years old, $2,500 tax. And the important thing here is tax credit, not tax deduction. Tax credits are always more valuable than a tax deduction. So, and it's refundable. So that means if you can bring your total taxable, bill down to 0, and you still have the child tax credits as a refundable tax credit, you can actually get a refund for that amount from the tax credit, which is, potentially for many families, depending on how many kids you have, a big deal. So
the government is actually going to pay you to have kids. That's right. That's what that child tax credit does. Now, I will tell you, do not go have kids to think that you're going to make money in a net profitability way on the kids. They're going to cost you way more than whatever that child tax credit is. But at least you get a little bit of money back from the government for having kids, because of course, we all want more kids out there, so especially smart ones that will be raised and do good things and make our world better. Like, why wouldn't we want more of that?
Absolutely. Number 5 is R&D expensing reinstated. So the businesses can now fully deduct research and development costs in the same year again. I don't know much about this provision, but I thought it was interesting and worth mentioning. So, I mean, a lot of startup companies, companies that have a lot of R&D at the beginning stages of running a business, that can now fully deduct those expenses that they're applying towards those initiatives. And I think especially for new businesses, that can be pivotal for them from a growth standpoint.
Yeah, so R&D research, it stands for research and development. And so there's special tax benefits, tax credits that give you more than just a deduction if you're going to do things like research and development. Research and development has a lower probability of adding value to your business. It's a little riskier. When you do something that's brand new and you're researching it and developing it, it can cost you a lot of money to do that, and you might not make as much on the back end from all of that money you spent on research and development. And if you just get to take a tax deduction against your revenue that you otherwise have, that's not a very strong incentive to pursue research and development because it's so risky and generally not the ROI is just not there. Return on investment is not there as often. So the government had in place some of these tax credits that they've now reinstituted thanks to this situation that will encourage more of that research and development, which is great. That's how you get new innovations in products, new innovations in services. And given, if you think about the advancements that we've just seen in AI and robotics and a lot of these other industries in the last couple of years, and if you want to figure out how to take some of those advancements and turn those into a new product or a new service, that could easily be categorized as research and development as you're analyzing something and building something that's new and fresh or innovative and different than what existed before. And then those expenses could be more valuable than just a simple tax deduction. So you should take a look at the R&D credit and see if it qualifies and what you're doing, what the restrictions are and the rules are. But I'm glad to see that there. I'd love to see our world getting better and better, and the advancements in what we're capable of doing from a technological standpoint are earth-shattering and exciting to me.
Yeah, I think we're in a very unique situation right now with AI and everything going on with that, Tim, where a lot of people are referring to it as even like it's the second industrial revolution, where machines were taking the jobs of people back in the day during the industrial revolution. Now we have AI taking the jobs of many people from a foundational standpoint of that's happening right now.
Yeah.
And it's interesting.
And it's funny, whether you're pessimistic or optimistic about AI or somewhere in between or on the fence, or you don't even have a developed opinion about it, like you could be in any of those camps. Just to share, I personally believe that we're on the verge of a new renaissance. If you think of the Renaissance experience, all of the art and the creative art opportunities that came out of that, I think we're going to be able to lean into AI to do things that we've never been able to do before. I've often used the analogy. I feel like before AI, we were all singing a cappella, and AI was the invention of instruments. And now you can play instruments. You can grab a saxophone or a guitar and it never existed before. And all of a sudden, you might have been a horrible a cappella singer. You might not have been able to sing, but you were an amazing drummer. And all of a sudden, drums just got created. Now you can go drum and create amazing sounds that none of us have ever heard before. And I think that's the renaissance that we're on the cusp of. That's my opinion, at least.
You mentioned instrument. I keep thinking of that didgeridoo, that like long.
Oh yeah, there you go. There's the didgeridoo. There's always an instrument for everybody. Okay.
All right, let's get into some of the more pessimistic things that's coming out of the tax bill. One of them, depending on who you are, of course. One of them is the cuts to certain federally funded programs. Medicaid's a big one. Some of the clean energy initiatives and energy credits for those things are being slashed in certain areas. I don't want to put numbers on how much they're being slashed, percentages or anything like that, but those programs are being impacted.
Yeah.
To the extent of how they'll be impacted and how it'll impact listeners or other Americans, it's a little unclear right now. But it's worth mentioning and bringing up because now is the time to not ignore it, but to try to plan around it, especially if you feel like you're in one of the camps where it's going to affect you. And
yeah, well, and Medicaid, it's important to know who Medicaid affects, because a lot of people confuse Medicaid and Medicare, and they're two
Correct.
completely different things. Medicaid is the federal health care provided to those who are completely impoverished. Typically, if you're an individual not married, you need to have less than $2,000 in total assets. in order to qualify for Medicaid. Maybe some equity in a home, but not a very large amount there either. Fundamentally, it's meant to protect you when you are broke. If you have not saved, you have not been able to build up wealth, you do not have enough income for yourself, and you have spent through everything you have, and you still need health care, that's what Medicaid is for. And so that's where the cuts are happening. Medicare is what everyone gets at 65, and they pay the money for it on a monthly basis and everything else. And to my knowledge, I don't think there's any cuts in Medicare. There are cuts in Medicaid. And it's not that they're not saying that these people are going to be out on the streets. That's not what's happening either. They're just adjusting the program, I think. And I don't know what the differences are yet. I'd have to research that.
I don't either. I think they're pushing a lot of the powers and the decisions to the states to then make those decisions. And I think the federal is stepping back and probably stepping down funding to a certain extent to those states for those purposes. So,
and a lot of states have a very integrated plan with Medicaid. States typically will provide a significant part of the strategy and the funding and what they cover and what they don't cover and everything else in that process. So it could become a financial burden on the states that they have to figure out what they're going to do, either cut benefits or raise funds in a different way. But it could create some differences in the different states that we see, depending on what kind of Medicaid quality care they have in various capacities. Could make people want to move into certain states if they're in that situation versus be in other states that may not provide as much care. But we'll have to wait and see how that all flushes out.
That's right. Next is more of a long-term implication of all this, which is higher deficits. National deficit, national budget, how much we owe to other people, to ourselves. And they're estimating that the bill's going to add anywhere from $2.8 to $5 trillion over the next 10 years.
Yeah, so government's spending money by not taking it from you.
That's right.
That's what a tax cut is. They're saying we're not going to take the money from you, therefore we're going to eat it, and they're eating $2.8 to $5 trillion over the years ahead. That's and obviously that's going to have implications. The government's going to have to do cuts on its various programs in some capacities to do that, or it's going to have to raise that money another way. And we'll have to wait and see what the raising that money another way is. If it's not increased taxes, because the whole point of this is a tax cut, then what's it going to be?
Yeah. I think now's a window, which we have a longer runway or a longer window, if you will, now to plan accordingly for those things. A lot of people believe when you have a deficit, one way to pay that is to increase taxes. And obviously that's not happening right now, but could happen down the road at some point. Maybe it'll never happen if they come up with another creative way. Or if aliens come down, and then all of it's a moot point anyways. But that being said, if taxes potentially could be going up down the road, try to look at some smart things to do now while you have the availability of these lower tax rates, different benefits to you from a tax perspective right now. So
that's funny. I don't mean to laugh at aliens coming down. That'd be kind of cool, but
but
it was unexpected as a comment.
What if they came down? They're like, "Hey, your national deficit, boom, gone."
That would
and they're like, thanks, and they're
pretty impressive.
Peace out, go back to wherever they came from.
Okay, all right. I'm sure that's probably pretty low on the aliens' priority list, but I got you.
If you're listening to the podcast.
Yeah, if you could wave a wand to get rid of that for us just by magic. I mean, that's the problem. Obviously the U.S. government can actually print the money and just pay more stuff, but that creates massive inflation. Then stuff goes up. We have more costs as there's too much money out there circulating. So we're not going to see that happen either, not at a high degree. I'm not saying we're not going to see inflation. I'm saying you're probably not going to see them print more than maybe an 8 to 10% increase in the money supply on an annual basis, which 8% is kind of the standard for most large countries. When you have countries with staggering inflation, they're typically printing more like 14% or more of new money every year, and that's part of why we have problems. So I don't think you're likely to see them go above those certain thresholds, but we're probably going to see some inflation from this unless another revenue source comes in. And what am I talking about? Revenue source, the tariff revenue is absolutely another revenue source. It's a new revenue source. I don't know if it's going to stick around. I don't know if it's going to be a lot. I don't know if it's going to be a little. I don't know what the implications are going to be. There's a lot of hot emotions around the tariff situation. I totally respect all of the feelings about it. But bottom line is any of that money that's coming in is a new revenue source. And if it helps offset some of these expenses, then that maybe doesn't result in higher inflation for us or higher taxes for us. So we'll see how that plays out.
Last one.
Sure.
strategic estate planning opportunities. So there hasn't been any mention yet of them slashing or cutting the estate tax exemption, not state. But I think, that's another lever that the government could pull to bring in more money if they need to for whatever purpose they deem fit. And I don't believe, and again, this is my understanding of the bill, that there's provisions in there to lock in those higher estate tax threshold rates.
I don't know. I would need to research that. I haven't looked at that yet, but
they might be working on it.
I feel like it. I don't know. I guess I was thinking that they were going to make those continue as well. But I'll have to look into that. So it is definitely one of those things that you want to take a good close look at. If your estate is over $5 million, you're not necessarily taxed at a federal level right now, but it could happen to you in the near future if things change from an estate threshold standpoint. And if you're taxed, if you have over $1 million and you live in Oregon, you're already dealing with estate tax issues. So recognize that too. And when you're looking at your net worth for estate tax potential implications in the state of Oregon, look at the equity in your home or homes. Look at the total amount of your retirement assets and your bank assets, your investment accounts. And then also remember any life insurance death benefit will be included in your estate unless you have it set up in a special trust, but will be included in your estate if you own that life insurance policy. And then all that together, if it's over $1 million and it passes on to someone other than your spouse in the state of Oregon, you're going to be dealing with estate taxes. Your heirs are going to have to write a big check to the Oregon Department of Revenue. So, and there are ways to minimize that as well with some good, intelligent, strategic planning. But that's what we do, right?
That's what we do. That's what we do.
Anyway, do we feel like we've covered
that's
the
all I
bullets
got
for today? All right, I think that's a good head start. You got the appetizer and maybe the first couple courses of your full platter as far as dinner is concerned. I'm sure there's going to be more information to come on the big beautiful tax bill and its implications, but at least you got a little snapshot of what's going on. And I know we didn't talk about tips and overtime. I know that's a part of
it's in there. I know it's in there to certain caps. It caps out based on your income and how much total overtime and tips you have. So that's part of it.
There was going to be something about Social Security, some kind of offset benefits related to Social Security taxation at a federal level, and we got to dig into that.
I don't know if they changed the taxation of it.
Yeah. But I know there was maybe it was the standard deduction that was going to offset it. Anyway, we'll dig deeper, but at least you know what we know as of this moment.
That's right.
And by the time you listen to this, we'll probably know more because we're recording it, and by the time this airs, it'll have been a few weeks. So.
That's correct.
All right.
Just the answer?
Yes, go for it.
Okay. Topic of the day again was how will the new tax bill impact your wallet? So Tim and I went through 8 bullet points. I encourage you highly, if you have any interest in the actual podcast topic, not just listen to us rant at each other, go back and listen to the full episode so you can get the full breadth of what we talked about. But I'll hit the bullet points for you really quickly in a summarized capacity. First thing we talked about was the standard deduction. It's here to stay, so plan accordingly. Talked about the limits, what those look like. Next thing we talked about was the SALT deduction cap being increased from $10,000 to $40,000. SALT, again, stands for state and local tax. We talked about how that plays in with the standard deduction, what that might look like for you for your tax situation. Third thing was expanded QBI deduction for small businesses. QBI is qualified business income. We talked about what that might look like for small business owners and how that might benefit those individuals. Fourth thing was enhanced child tax credit. The child tax credit is now $2,500 per child under the age of 17. Again, that's a tax credit, not a tax deduction. Credits are always worth more than deductions when it comes to taxes. Fifth was R&D expensing has been reinstated. So if you own a business, you can now fully deduct your research and development expenses. And I think that's a great thing for businesses that are in that line of work where they have a lot of research and development, and it's usually a good thing for the economy because usually we want to promote research and development and expanding products, services, offerings that exist. Sixth thing was planning around cuts to federal programs. We talked about there are some cuts imminent for programs like Medicaid and other green initiatives like clean energy and things like that. So plan accordingly, understand what they are, and if it's potentially going to impact you, you might want to look a little bit more into that. Seventh thing was we talked about the long-term implications of all these tax changes, and one of them that many economists are hypothesizing is it's going to add anywhere from about 2.8 to about $5 trillion to our national deficit over the next 10 years. What that means to you might be different to the next person. Your feelings about that and all of that included. So that was more of an FYI. How that will impact the grander scheme of things over the years ahead, we'll have to kind of wait and see. Last thing was strategic estate planning opportunities. We talked about the estate tax threshold limit. Right now, we don't have a lot of clarity on what that's going to look like, if they're going to cut it back to what it was prior to the Tax Cuts and Jobs Act 2017, or if it's going to stay locked in at the current higher rates. We'll have to wait and see what that looks like, and you can obviously do your own research as well if you're interested.
I can't wait to go ChatGPT a bunch of this stuff, see if we can get to the bottom of a few more of these items.
Yep.
So thank you very much for joining us on that part of it. I think we still need to move into our trivia, though, at this point.
We do.
Right?
We have trivia.
All
We
right.
have trivia for Tim.
All right, what'd you hit me with? Stump the Nerd. Let's go.
Okay, Stump the Nerd. What is the first toy to be advertised on television?
Ooh, the first toy to be advertised on television. Okay, it's trivia time. You're thinking out there too. Maybe you already know the answer. Maybe you don't.
We need some trivia music. Maybe we
feel
can dub that in.
Yeah.
You know, like
Right. It's like when right on advertised on television.
on television. I have multiple choice if you're
I
interested.
mean, I was like, well, one of the first things, it's probably just a red ball, but no, I don't know why, but it's a Slinky just comes to my mind over and over again. But I feel like that was way later. That's only because that's one of the first toys that I saw on television. It's certainly not one of the first toys that was on television. Give me the multiple choice.
Okay, we got Lego,
Okay.
Mr. Potato Head,
Okay.
Barbie,
Okay.
and Slinky.
Oh, Slinky's on there.
Yes.
Oh, Lego, Mr. Potato Head, Barbie, and Slinky. I think it's either Mr. Potato Head or Slinky. And I'm just gonna go with Slinky because that was my gut in the beginning anyway. So we'll just say Slinky and see what happens.
Mr. Potato Head.
Oh, so be it. Mr. Potato Head.
1952, Mr. Potato Head became the first toy ever advertised on TV, changing how toys were marketed forever.
You know, he just never got enough credit. Mr. Potato Head was pretty cool.
He was a russet. He was a russet potato,
he was
also known as a tuber in the tuber family of vegetables.
Well, look at this nerd stuff. This is good. No, that's what we got. We got. He had feet. He was a potato with feet and arms and eyes and a mustache and a hat. I was like, there you go. And that's a brilliant toy that will go down in history forever as the very first toy to be
Very
advertised
tasty
on
as well.
television. So yeah. I'm gonna get some potatoes for lunch.
Yeah, that sounds
All right.
good. Tim, any wise words to round us out for the day?
You know, the two things you can always count on being around are death and taxes, right? We all hear it over and over and over again. Can't do anything about death yet. Hopefully later, but not right now. Taxes we can plan around. Taxes we can't change the rules. Once the rules are in place, the government will make the rules. Now the rules are in place. Now it's time to decide how do you change your behavior to keep your taxes at their legal minimum. And that's something that we will be working very hard on this year to adjust our strategies to accommodate the new shift in the tax law.
That's well said.
There you go.
Very cool.
All right, thanks for joining us on Clear Money Talk. Have a wonderful rest of your day, and know that we're here if you want to have a clarity call and do a touch base, or if you're interested in possibly considering working with us, you can call us at 503-579-1000, and feel free to check out our website at clearfp.com. That's clear, F as in Frank, P as in Peter.com.
Thank you, Tim. Thank you for all of your time. We will catch you on the next one.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetere Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetere Investment Advisors, LLC, a registered investment advisor. Cetere is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetere Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetere Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetere does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetere representatives may offer these services through their independent outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59.5 or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59.5 may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying subaccounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often, target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetera does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Clear Financial Partners is located at 15573 Bangy Road, Suite 100, Lake Oswego, Oregon, 97035. For more information, please call us at 503-579-1000.